Good morning. Good morning, everybody. Welcome to another episode of The Full-Time Investor. I'm your inspired investor host, Mandy Brenham, and here to share with you another great couple to, actually, it's the first time I've had two people on my show today, but it's a couple that you're not going to want to miss. You're going to want to gather your entire family around. If you're of my generation, grab your parents. These people are super inspiring. If you are of any generation, this is the show for you today. So I'm honored to be able to have some special friends, some partners, some inspirations in my life. Doug and Anna Scott here with me today on my show. There they are. Wow. There.
Quite the introduction.
Yeah. So Doug and Anna, we are part of a group together. That's how our paths originally kind of crossed. And now it's been amazing to be able to watch each other grow and develop into the investors that we are, into the portfolio that we have, and certainly be able to follow along with weddings and babies and vacations and stuff. So why don't you guys share with the audience a little bit about who you were, how you got started into real estate, and why when you were in your life that was the time that you decided that you needed to get into some real estate.
Wow. You want me to start?
Oh, sure.
So we, Doug and Anna Scott, we started real estate investing just a little over 4.5 years ago, specifically March of 2015. Before that, I mean, we have our house and our cottage, and we used to rent out our cottage to just family and friends, acquaintances, but not with any, more just to help pay the property taxes, things like that. But we realized that after we had attended a workshop, a real estate education workshop weekend, that, there was something more to, we had all this dormant equity sitting in our house and cottage. We had pretty much we had our house paid off and our cottage pretty much paid off as well. And it was always something nagging at me to say, and both of us, that we've got all this equity. How can we better utilize it? How can we take advantage of it? And it was until we started, learning a little more about real estate investing that we said, you know what, let's dabble into this. Also at the time, Doug was, we were in our early 50s. I'm 50. I just turned 56 recently. Doug's 59. And we said, we're going to be retiring probably in the next 8 to 10 years. And what's going to keep us busy? What are we wanting to do? And it was at that weekend that we said, you know what, that's what we want to do. We want to get more involved in real estate investing. So fast forward to now, and we've just hit the ground running. Like we started right away with getting incorporated. We've bought multiple properties. We like to do the long-term buy and hold multifamily strategy. Have acquired multiple properties, haven't sold any. Haven't flipped any. That's just not our style. We like to hold on to it because we have 2 adult children. They're now 28 and 24, and we wanted to be able to create a bit of a legacy for them as well. We're now new grandparents. Our granddaughter just arrived at the end of June too. So we formed a corporation. Our children are shareholders in our corporation. They own all of our properties with us. And we want to eventually, 5 or so odd years down the road, if they want to become more actively involved in in our corporation, absolutely. In the meantime, we've been accumulating properties with the longer term goal of eventually passing on the corporation to our children. Or if that's not their bag, if that's not what they want to do, then we will look at either divesting our portfolio, start selling off properties, or even selling off the whole corporation 10 plus years down the road. So we wanted to be able to take fullest advantage of the dormant equity we had in our homes at the time. We also had, we were the good Canadians. We saved a range. They invested in RSPs, TFSAs, maxed out our contributions. We thought back then that in 6 and a few years, we were able to get like 8-9% rates of return in with our financial advisor. Thought that was the cat's meow. And then when we looked at what the possibilities were in real estate, private lending, private equity, land development, all that great stuff, we were able to invest in those projects and achieve a higher rate of return than just our conventional RSPs and TFSA investments. Your turn.
Doug? I thought when you said there was something nagging in you, and then you quickly chimed in nagging for both of us, I thought you were going to say that something was nagging, but that's not the
Not
style.
something.
Yeah, our goals before learning about real estate, you get income from a job and from a pension, and seeing all of the different avenues and investment types available related to real estate really opened our eyes, and we jumped right in.
So you're at the age that you were at, and you've gone into this, and they always say the best time to buy real estate was 20 years ago, and the next best time is right now. How did you guys decide to harness the right now? Like, was there something that was it something that sparked you? Was it we knew there was more, or was it just, I'm always in the right place at the right time to meet the right people to make the right deal?
Well, if I could just jump in at this point, we realized that the rates of return through the real estate education that we received, that we learned how to properly assess a property to determine if it's a good cash flowing opportunity or not. We kind of built on that knowledge. And also we were working full-time, crazy, stupid hours. I was in corporate compliance. Doug was in IT. He was doing a lot of releases in the evenings, at nights. And we were making good money, good salaries and such, but we realized we didn't want to necessarily get like what you're doing, which is doing the property management. You're doing the day-to-day hands-on and part of the investing. So we learned that through joint ventures in particular, and you're our very first joint venture, that we could be financial partners and be involved in real estate without having to be landlords ourselves, right? So having said that, we do have our very first property was an 8-unit that we decided, let's just jump right in, commercial property, commercial financing. We do the property management. We are the landlords. We wanted to see firsthand what it was like to be a landlord. We continue to manage it ourselves because we've been fortunate enough to have great tenants, but I think that's partly because we learned how to properly assess and vet, prevent against professional tenants, that sort of thing. We still want to keep our hands involved in that, but we have done since then 7 other joint venture partnerships where we've been the financial partners for all of those. And we also have an 8th property where, using RSP funds, I've done a self-directed mortgage, and I'm the bank on a triplex for another client. So it's we learned we didn't have to be landlords, but it's great. And because at the time we were working as a full time, and we started accumulating properties. Like when we first started, June of 2015, we incorporated. We took possession of our first.
Why? Mark Smith here, a listener right now. Thanks for being here, Mark. Mark asked why, and I think you've touched on a few bit, but maybe just quickly go why you decided very quickly to incorporate.
Yeah, one of the key reasons was we'd worked all our careers in a job, saved up a decent nest egg. We had assets that we wanted to protect in case things did go wrong. So that was one driver, but also bringing the kids in as non-voting shareholders to the corporation was something that we thought if things go well and the kids are interested, then maybe this is something that they can carry on with.
Yeah. So it's really largely asset protection because we have substantial investments in non-real estate that we wanted to protect. And I mean, yes, as we've acquired our properties, we have appropriate insurance on each property, but it's the umbrella of a corporate structure that helps to protect us even more. And as we said, from a legacy perspective, we wanted to set that up right away for our kids to be involved in our endeavor going forward.
And from the accounting side of things too, you get to take off your expenses before calculating income, which is nice, and it allows us to go to meetup groups and network with other people.
Yeah, yeah. Now, you guys, I really like, and I mean, I think I've followed along and grown with you, but there's always this. There's a part of people that are like, oh, I wish my kids would get in. I wish my kids would hear this, and I know you've set them up this way, but even a couple times you've just been like, if they choose to, they choose to. So you are role models right now. How are you having these conversations with your children to be able to say, what if they're not interested, or what are you kind of doing in the back end to be able to share with them a little bit without overwhelming them and pushing it on them, and just leading your investment portfolio for yourselves right now?
Yeah, we've tried to share things that we've learned
The books,
with
the accounting,
our children. It's been a lot of years. Matthew still hasn't read Rich Dad Poor Dad, despite asking him every time I see him. But I've let him rent some money for a private lend.
Yeah.
So he's kind of liking that there's money coming in every month that he doesn't have to work hours for.
Okay.
So I think he's starting to come around.
Yeah.
So when we, like most recently, Thanksgiving weekend, we sat down with our son and showed him our recent year-end books and the income generated from the properties. I mean, it's still a little overwhelming, daunting for him to get down to the nitty-gritty of the figures, but any opportunity that we get together, we talk about, well, certainly as we acquire properties, we always send pictures or texts and say, hey, this is another building you guys now own with us, right? And they say, oh, cool, and the private lending opportunities that come across to us, and we say, are you guys interested in doing this? This is what this means. Most recently, as I said, we're new grandparents, and a consideration for them was, okay, our son wants to go on paternity leave. Our daughter-in-law is already on maternity leave. What does that mean from a household income perspective? Are they able to manage that? And so our son is getting interest income from the private lend. They're now getting child tax benefit as well. So they've been able to supplement or replace a big chunk of the income that was lost because of going on maternity leave. And also the paternity, he's fortunate enough, he has a company that will supplement his income up to 80%.
Yep.
So the finances side of things. So we're looking to help them. And our daughter as well, who's in Australia right now, we're looking to do a private lend with her, for her, so that she can supplement her income with interest income payments per month as well. So she's liking that. We're teaching them about how that all works and the promissory note process. It's not like all of their nest egg is necessarily going into private lending, but certainly we're teaching them or showing them, here's a deal that we're investing in that we think would be great for you, or here's another opportunity that we've lent them money before and they're good for it. Here's the process. So they're learning as we go, and when they see the interest income coming in every month, it's like, oh, this isn't too bad after all.
So now I'm gonna get you to reflect from my perspective onto who I would look at and say, I wish my parents, I say wish, I mean, they're beautiful people the way they are, and that's good because everybody's leading their own trajectory. But how can somebody from a younger generation offer to their parents, who are the ones that have had an extra 25 to 30 plus years on the planet, 25 to 30 plus years doing I know best, and the government has pretended or has created this way for us to follow, so parents, a certain generation, have done what they're supposed to do and have shown up. And I question, how do I talk to my parents' generation, to my aunts and uncles, to be able to say there's still time for you to invest in real estate? And what would be some of the things that might have helped you if it was your children having this conversation with you, trying to say, hey, mom, have you ever considered this? Or what would be something that you might have liked to hear that would have unlocked you sooner?
Well, the very first thing that comes to mind for me is one thing you should recognize with people with wealth is it's all about wealth preservation and continuing to grow the wealth to be able to pass on to the children, potentially. Maybe some people want to spend it all and not leave anything for the kids. But for us, and with any of my my parents wanted to give us something when they left this world, right? So how to approach parents who have wealth is, in my opinion, is to demonstrate, how is risk being mitigated? How much money would they be willing to have those conversations just over coffee? Just start saying, Mom, you've got, or Dad, you've got, hundreds of thousands of dollars of equity in your property. How do you feel about tapping into some of that, maybe the home equity line of credit? Not the whole thing, like maybe 25, 50,000. Like, would you be interested in putting that towards a private loan, 6 to 12 months? Somebody who's flipping a property, you can get 14, 18%. Longer the term, of course, the higher the risk, the higher the reward. So start having those conversations with them. But also, one of our friends, Alex Powell, his parents did their first joint venture with him, and they saw, hey, this is pretty good. He's getting a good rate of return. We're getting our money back. When can we do the next one? So by example, as well, if the kids can take their own money, invest, and show, hey, you know what? These are the appropriate risk mitigation strategies I've taken to ensure that I'm going to get my money back. And again, don't start with a big chunk of change. Start with maybe 20, 40, 50,000 and show them that this is possible and you can get your money back within a relatively short period of time. So by example, and also how can they risk mitigate? And so one of the things that if I'm going to invest privately as a money partner, I like to do the due diligence. I like to check out the not just the deal, the property. And now that I know how to calculate the numbers as well, check out my prospective investing partner. Have they done this before? What's the track record been? What kinds of rates of return are they getting? Have other people borrowed money from them? Has their experience been? So I would emphasize to the kids to say to the parents, here's the additional investigating you can do to give you that peace of mind. But just start with the conversation over coffee. Or them just say, how do you feel about that? What are your concerns, and how could we make you less concerned? Would you even begin to even want to just try investing like 20,000?
Right.
And without some education on why, say, 14% is a reasonable amount to get on a private lend, and the fact that it's so much different than a GIC doesn't necessarily mean that it's automatically riskier. But there are reasons why people can pay that, and usually they're making a lot more money than the 14% that they're paying you on your little chunk of the
So you're offering for them to see one side of it, which is the private lend side, and at the same time you're almost educating them as to what that lender would be doing with their money. So they're kind of going, hey, I'm happy getting 14%, but wait a minute, that person that's doing the flip or the flip to himself and the BRRRR is actually making higher. That could be the next step that somebody could make after they kind of get into this. And it is just a conversation. I like that. Just a coffee. Yeah. Where can we kind of go with this? I've been, little tidbits along the way. I feel like Hansel and Gretel going through the forest thinking, what, I'm not going to bombard them. Although I did when I started. So I think it's sometimes a little bit of a backup as well to be able to say, I want, like you said, Alex Powell, what a phenomenal investor, just won a top player award at Rain Canada this last week. And so he has created a track record for himself to be saying this isn't my first deal. Would you like to hear about a couple of the other ones that I've done? Would you like to see how I've borrowed money and paid it back? And so education is a big piece for sure to be able to hit people. But I really want people to feel your acceleration of your retirement, where, so from where you were, you kind of started us off 2015, and here we are at the end of 2019. So what's kind of gone on in that snapshot? You've indicated you bought some properties, but what has it allowed you to do?
Well, just briefly, the over the last 4 years, we were very strategic in how we used our available capital. So as I said, we had our house paid off, our cottage pretty much paid off, and we initially didn't want to use any more than 50% of the equity in those two properties combined. So that would have been about $500,000 to use for investing. So we said, okay, well, what are the main property or rather real estate investing streams that we can do? And we first and foremost said, let's go for properties, because that's where the highest rate of return, highest ROI is over the long run. And as you've heard, you don't wait to buy real estate, you buy real estate and wait.
Right.
So-
Building the long-term
Building the
wealth.
long-term
Yes.
wealth. So we used our lines, home equity line credit to acquire our 8-plex in July of 2015. Then we, through our real estate organization, found out about land development opportunities. So we started tapping into some of our RSP money and TFSA money to invest in those opportunities. And that was like by about November of 2015.
And that's
Long
over and
before-
above. That's over and
Yeah.
above your $500,000 equity.
Yeah,
Yes,
yeah,
that's
that
right.
was money that was 5% bonds, 6,
Yeah.
7% stocks. Again, some diversification there, and
And then by January 2016 was when we acquired our first, our 2 more multifamily properties. They initially, we had 2 joint venture partners come to us. We started doing the dating in the summer of 2015, and we had conversations with yourselves and our other partners. We went up to the communities. You guys just blew us away with how knowledgeable you were about the community, Midland, of course, in London, Ontario. And so we said, okay, here's the kind of property we want you to find us. Here's another, here's your budget. Here's what we want you to do. And both of you came back within a day of each other, having properties under contract, and they both closed January 31st, 2016.
so the original, I think,
Yeah.
They were going to close the same day.
Yeah, and our
but,
lawyer came back and
yeah,
said, could
we
you swap
switched
that so
around.
there's 2? So you closed mid-January and other property Jan 2016. So then we started, our goal all along was to say we wanted 10 properties in 5 years. So that's 2 properties a year. So by mid 2016, we're already now at 3 properties.
Mhm.
And so we've been trying to keep to that pace of a couple properties per year. So fast forward now, we have the 8. And this is our 4th, going into our 5th year. So we have the 9th that I'm funding the property for. But we bought property, we invested in land development, bought property, land development, bought property, then we started investing in private REITs. So to diversify even further. In the fall of 2018, we assessed, can we retire sooner than our anticipated retirement age? So everybody usually retires at 65. We knew we could retire comfortably in our early 60s. Now, Doug and I are 3 years difference in age. but-
So the financial advisor that we've been working with, they had a plan. Okay, so based on these rates of return, how much you've got in asset base, yeah, you could retire comfortably during this time frame.
Yeah.
What wasn't included in that is all the extra from the private lending that we've been doing. So when you add 20, 30,000 a year, that changes the retirement profile a little bit.
Yeah, for sure.
Very
And
good.
when you look at rates of return that are more than the 4, 5, 6% in the traditional investments, and are looking at rates of return related to real estate, it means that your asset base can go a lot farther.
Right. So we started this in fall of 2018 to say, actually 2017 rather, to say, can we do this? What will we do in retirement? And Doug started, reading a bunch of books, podcasts. We wanted to make
Started? Doug reads more books and listens to more stuff. I love I get these little articles in the back end. Hey, I'm not sure if you've seen this. And I think if Doug's read it and thinks of me, I need to read it. So you're super knowledgeable. You're very up to date.
And so we said, how much income do we need to be able to retire? And one of the things I wanted to just make clear is, we were making really good money full time, but we were socking it away in RSPs, we were living below our means. We had, more, all this excess income. So we decided how much money do we really need to be able to not have a day job? And so we started that process in the fall of 2017. By January 2018, we started, we started refinancing what we could. So we refinanced our house, we refinanced our cottage. We freed up all this available equity in the HELOC to be able to use intentionally for lending purposes. Because we knew as we didn't have a day job anymore, we wouldn't necessarily be able to qualify for mortgages because we didn't have the employment income. But we had purposely by design, so we technically left our jobs at by June 1st, but we did our first private lend in April. And then we just started going from there. So when our employment income dipped, our interest income from private lending started to build up and replace a bit of that. So to this point, I mean, we've been retired a year and a bit now. We are just going to be tapping into our RSPs in January to fund our lifestyle. And the rest has been pretty much interest income from private lending that's been supplementing our. Now, having said that, I did move a Lyra to a LIF, but and I started that in January, so I'm getting a little bit of LIF money. He did retire from his work, so he does a bit of a pension, but the rest has all been supplemented by real estate income, be it cash flow or interest income. Yeah.
And the retirement lifestyle is great. We went to Cancun, Mexico in January, and just got back from a trip to Italy and Greece cruise.
Yeah.
So
We're
So
already
we're looking
planning
at
our
it.
trips next year, and
Yep.
yeah,
And you had your son's wedding, and like you've
Yeah.
had all these life things, and you haven't had to compromise on a lifestyle or think, oh gosh, I'm going to go on this trip, but now I have to I have to stay at work for an extra couple years to be able to supplement this. You certainly have been able to maintain, if not a little bit
Right.
of things maybe you didn't think you'd be doing at this age or at this stage, but you really are.
Something I should mention too is we just closed on a sixplex in September. So we did commercial financing for that property, and so yeah, we don't have employment income, very little other sources, but because of the nature of commercial financing, it's based on the property and not necessarily they did look at us as well, but now that we had built a sizable portfolio of other assets, they did take that into consideration as well from a debt service ratio perspective. So just because we're retired doesn't mean we can't continue to acquire property either, right?
Yeah.
So this is our goal to try and I'd like to hit the 10
Yeah.
within our 5-year goals. So that's coming. One of the things we're looking at right now is, the capital is starting to deplete, but we've had a number of people come forward and say, yeah, we love what you're doing. You guys are really, we want to emulate you and we'd like to be involved with opportunities that you're coming across. So we think that we'd like to maybe get another big building and have some other investors work with us.
Do a joint venture yourself where you are the knowledgeable people. Not that you're not knowledgeable I actually believe that my passive investors are more genius sometimes than I am, because I'm like, wait a minute here. They just got this great return on a property and they're in British Columbia and have never stepped foot in my town, let alone shaken my hand. They're the geniuses. But yet it takes a genius to know a genius. And so either side of the coin, getting into some real estate is a great way to be able to do it.
Mm-hmm.
Now, you guys have taken the education piece because, again, there we are, so having that, whether it's one generation to the next, we're saying, let's get some education. And you have started a group where you are, if you want to share a little bit about your group, because I feel this education piece, it doesn't have to be joining, a coaching group such as we did. If people aren't sure where they want to get started, it's about, you don't know what you don't know. And so this is us sharing with people an opportunity.
Absolutely. Even after joining our real estate organization, we started to meet with other real estate investors. So in the fall of 2016, we started something called the KWC, or Kitchener Cambridge Real Estate Investors Group. And it was very informal. We had about 7 couples, 14 people. We used to meet for dinner at a local restaurant. People from, it was in Cambridge, from Kitchener, Cambridge area, would get together and start talking about what are you doing in real estate. If there were any successes or challenges, we would share that with each other. Who are you using for mortgage brokerage? Who are you? We would just start talking and share all this information. So this is fast forward now that we have monthly meetups, and usually from September to June. And it's usually the last Wednesday of every month. We meet at the Cambridge Hotel and Conference Center now. And I usually bring in, it's all about real estate education for me. And quite honestly, whatever we're doing personally, I usually bring in guests to help support what we're doing personally. So if we're working on commercial properties, then I'll bring in a commercial realtor to talk about commercial properties. Or I was really into Airbnb in June, so I had a couple of presentations on Airbnbs. Most recently, we had Laura May in September to talk about shipping container homes. And Alex talked about his flipping strategy. I've got a couple of really great guests this month talking about creative financing and how to, Matt Geertz and Matt Piche, how to raise capital. So, because that's directionally where we're heading. How do we, I mean, we've talked to a number of people. We go to a number of meetup groups ourselves.
Yes.
We are not just providing a forum for people to get together and talk and network and make connections, but we are also in continuous learning mode. We go to, you know, Quentin's members of his group. There's a huge spectrum between London and Ajax that we attend on a regular basis and meet. And,
so there, it's started with, you know, 12 people a number of years ago, and usually
Now,
40 to 60
depending on the day. And I have over 200 names on my email distribution list as well, because I like to send other stuff to people.
Yeah.
But it's all about education, networking, and most recently I was at another event and my name came up and somebody said, "Hey, you're the person that connects people." And I said, I think I am.
Yeah.
So just by providing those opportunities or because I've met so many people at different events, and I'll be talking with somebody and they'll say, "Well, who would you recommend about this?" And I'll say, "Okay, you got to talk to this person, you got to talk to that, or whomever." And even at our meetup group, there are people who have done deals together, and that's just so gratifying, so rewarding for us to know that we provided an opportunity for people to be equally, if not more so, successful. So that's at the end of the day, and I saw your podcast with Erwin. It's all about, we're such a giving, sharing community.
Yes.
That we're all wanting each of us to be successful. So whatever opportunities we can present and to make people allow them to talk and grow and build on their portfolios. That's our goal. So we'll keep doing that. Until it's not fun anymore.
I just think
we're
that
into our third year.
Yeah, you guys are just such a valuable, unique couple in the real estate world. I mean, like I present sometimes just as Mandy, and knowing that Larry is such a big part of who I am, but it's always Doug and Anna, and you're there together. And you're always at these, you know, various different groups, but you've done a lot of different type of investing as well. And so I just think you're just a plethora of knowledge for people. And I know Larry has shared all your contact information on the bottom of the show. So if you've missed it, just kind of rewind a little bit, go back and get that. But your email, your phone number is on there. And I see your little emblem at the top there for your Kitchener-Waterloo Cambridge group. And so the next meeting would be when?
Wednesday, October 30th.
Okay.
And from 6:30 to 10:30, we have half an hour for networking. Then the meeting proper starts at around 7. We have 2 guest speakers. They each get a full hour for their presentation plus questions. We then have a good chunk of time for people to network, a bio break, that sort of thing. But one of the other things I like to have is something I call "You Have the Floor." So after the second speaker is up, then guests, attendees have an opportunity to come to the front of the room or stand and share, you know, what are they pitching a JV? Do they have a house for a property for sale? Do they have a challenge that they'd like to share with the group and get some group feedback? And it's a very intimate but informal setting for that kind of conversation.
Yeah, or share successes. Like Harry at the last one shared some of the things that he's been doing.
Senator property successfully, yeah. Oh, great, Mark. I want to see you there too.
Yeah, that's awesome. So you know what, you guys can please continue to be mentors to your generation, to other people's generation, just to, you know, the power couple that you have certainly created yourself to be. I'm grateful that you took a chance on me. I talk about you guys often in my conversations without saying any names, of course, but you know, one of them was that you know, my first JV took me days to be able to negotiate and talk about and get all the answers collected. And then, you know, 10 deals later, I got off the phone and it was 20 minutes, but it was because of the learning that I had with you guys and all of those questions that we got answered. The other thing I share is you are right. You did say, this is the kind of property that I'm looking for, and this is my price range. And I remember driving in front of this property going, that is Anna's property. And I felt it was a match match to you. And so I started to learn from there that every investor kind of has a different feel for what it is they're looking for. And so that property just called your name, and I was like, that just has to be the one that I share with Anna. So you know what, you guys come with me whenever I go, whenever I share, and so I need to thank you for being here and being my guest today on the show. And I look forward to following your 5-year 10 property plan. So Larry's giving me the cue that's it for another week of the Full-Time Investor. I'm Mandy Brenham. I thank you all, Susan and Mark and Chris and Denise, for being here and watching. And leave us a shout, put us down there, share this video. You know what? We just want to be able to start to plant the seed that everybody needs real estate as part of a diversified investment portfolio. The marketplace right now is in a changing atmosphere. We've got a lot of unknown in the stock market. And so, you know what, if you're looking to be able to say, what else can I do? How else can I start to take control? There's great groups, great meetups, great people, great videos, great podcasts. So please share this video with somebody that you think would benefit from understanding that there's more out there than the regular investing that they've done. And let's help everybody get real estate today. So thank you everybody for watching. Mandy Brenham signing out for another week.